The digital crypto-friendly bank Silvergate is now in talks with the Federal Deposit Insurance Corporation to salvage its business. FDIC examiners are now at the bank's offices, a sign of the urgency around the bank's lending woes. Yahoo Finance's David Hollerith has the details. David.
Inez, because the FDIC is regulated by the Federal Reserve, the San Francisco Federal Reserve is likely to decide what's best for Silvergate at this point. Now, even with the Federal Reserve and FDIC involvement, Silvergate could still stave off failure. And in that scenario, it sounds like it would be something like crypto investors or other firms offering more liquidity. If Silvergate can't find a solution, banking regulators will put the California bank into receivership. This is kind of like bankruptcy. In that scenario, the FDIC may also try to sell its business to a healthy firm. And in parallel, Silvergate's holding company could also file for bankruptcy. It owns the technology assets of Meta's sunsetted Diem stablecoin. It also has a payments network built for crypto exchanges that's quite valuable, at least to that industry. And if Silvergate does go into receivership, it will be the largest bank receivership we've seen since 2010 in the U.S., as Silvergate has at least $10 billion in assets. It also has $4 billion in loans from the Federal Home Loan Bank of San Francisco, but those loans are fully collateralized from what we know. So how this all happened, effectively, the bank's balance sheet grew too much by catering to crypto clients. It started serving crypto customers, or mostly exchanges and other firms, as early as 2014. Now, when FTX collapsed back in Q4 of last year, its total deposits, which had previously been stable, fell 52% from $13 billion in Q3 to $6 billion. And it also reported $1 billion, or nearly $1 billion in losses. So from that perspective, in the best of times, the company's net income averaged about $500,000. So this was $500,000 per year. So this was a huge loss for the quarter. And getting those deposits pulled so quickly also meant they needed more cash, more liquidity, and reported further losses last week, which obviously caused a number of firms, including crypto companies, to yank more deposits, which has only hastened that problem. So for crypto firms, I think what we can tell is until there's any wrongdoing made, which at this point no wrongdoing has been brought to our attention by regulators, is that, if banks want to serve crypto firms, they have to be sure to keep it as a lower portion of their total balance sheet or total deposits.
David Hollerith, Yahoo Finance's David Hollerith, thanks so much for joining us.